This is Quent Bilo with a discussion of the learning objectives of chapter. In this talk, I just wanted to focus on the first objective, preparing entries for cash dividends and stock dividends. The other objectives will be discussed in a different talk. I also want to discuss stock splits. Now, for cash dividends and stock dividends, we'll make journal entries, but for stock splits, there's no entry made for that event. Both stock dividends and stock splits result in an increase in the number of shares of outstanding stock, but neither give a immediate tangible economic benefit to shareholders, since each shareholder receives a pro rata or equal proportion of shares that they already owned. So again, just concentrating on dividends, cash dividends, stock dividends, and stock splits technically are not a stock dividend. Some of the effects are similar, but not all. So, dividends. Distributions of cash or stock to shareholders on a pro rata basis. Two types of dividends we'll be discussing, cash dividends and stock dividends. There is an item called property dividends, but they're very infrequent, and I'll not be covering it in this course. Cash dividends are normally expressed in terms of dollars per share, like a 5-cent cash dividend per share. Stock dividends are typically expressed as, we're going to give a 2% stock dividend. That is, 2% of the outstanding shares will be additionally distributed to existing shareholders. In cash dividends, it's important to note that assets are actually distributed to shareholders from the corporation. In terms of stock dividends, though, no asset is distributed. We'll make a journal entry, but there's no distribution of assets from the corporation to shareholders. So, focusing on cash dividends first. For a corporation to pay a cash dividend, it must have three things. One, retained earnings, positive retained earnings or a credit balance. Secondly, adequate cash. And lastly, a declaration of dividends by the board of directors. All three of these must be present for a corporation to declare and pay a cash dividend. Now, cash dividends are declared out of retained earnings, which reduces that part of the equity section. That's why there's a retained earnings section in the first place for corporations, a limit on the amount of dividends that can be declared and paid. But of course, the actual payment comes out of cash. So the upshot of a cash dividend will be to reduce retained earnings with a debit and reduce cash with a credit when all the dust settles. There are three dates applicable to dividends. In the case of a cash dividend, there's first a declaration date that they intend to pay a cash dividend. In this case here, the illustration is December 1st. The corporation declares that a cash dividend will be paid. It's at this point that a legal liability is established. A journal entry is made on the declaration date. Date of record, in this case here, choosing December 22nd, that simply means that the dividend will be paid to shareholders of record as of that date. A person selling their stock between December 1st and December 22nd would not receive the dividend. A shareholder must own the stock as of the record date to eventually receive payment of the cash dividend. Lastly, there's a payment date. In this case here, January 20th, where the company actually issues dividend checks in payment of the dividend, reducing cash and reducing the liability they established back on December 1st, the declaration date. The time frame seen here is typical. In fact, there could even be longer time frames between declaration, record, and payment date. Let's illustrate a cash dividend. On December 1st, the directors of Media General declare a 50-cent per share cash dividend on 100,000 outstanding shares of $10 par value common stock. Dividend is payable on January 20th to shareholders of record as of December 22nd. So, three dates here. Declaration date, December 1st. Date of record, December 22nd. Who owns it as of that date? They'll get paid on January 20th payment date. So the first thing is to declare or to determine the total value of this cash dividend. 50 cents a share times the number of outstanding shares, 100,000 shares, or $50,000. We're going to debit cash dividends for $50,000. We could debit retained earnings directly. Both of these accounts are used in practice. Cash dividends, if used, is eventually closed into retained earnings at year end. I prefer to actually debit retained earnings first and credit dividends payable of $50,000. Again, a legal liability is established at the declaration date. The corporation intends on paying this dividend at a later time. December 22nd, date of record, determining who actually owns the stock as of that date. No journal entry is made. Simply a determination of who owns the stock. January 20th, the payment date. Dividends payable is decreased with a debit, and cash is decreased with a credit. The cash dividend is paid. If there are two different types of stock, preferred and common, and cash dividends are declared, there must be an allocation of dividends between those two types of stock. Preferred stock exists because it has its first claim on dividends. Common shareholders get dividends after preferred shareholders have received theirs. Furthermore, if the preferred stock has a cumulative feature on it, those shareholders must be paid any unpaid prior year dividends that were not declared before common receives its current year share of cash dividends declared. Let's illustrate that. December 31st, IBR had 1,000 shares of 8% $100 par value cumulative preferred stock. It also had 50,000 shares of $10 par value common stock outstanding. At year-end 2014, the director declared a $6,000 cash dividend. Let's prepare the journal entry to record the declaration of that cash dividend as of the end of 2014. At the bottom of the page, there's a calculation as to what amount the preferred stockholders would receive in a cash dividend declaration. 1,000 shares times $100 par value times 8%. The 8% is the expected cash dividend that they want on their stock. This is the contract between the holders of preferred stock and the corporation. 8% of par value, or in this case, $8,000 is the annual cash dividend they expect. Now, the corporation has only declared a $6,000 cash dividend at the end of 2014. So guess who's going to get it all? It's going to go all to the preferred shareholders. And furthermore, in the next year, if there's a cash dividend declared, the $2,000 difference, it's called dividends in arrears, will go to preferred shareholders first. But to make the current 2014 declaration of cash dividend entry, debit cash dividends or debit retained earnings directly, $6,000, the full amount of the dividend. Credit dividends payable, $6,000. Now, the dividends payable account could have had a dash preferred shareholders only. That's only who can receive the dividend because of the amount entitled of $8,000. All of it goes to preferred shareholders. None of this $6,000 will go to the common shareholders. Again, if that cash dividend account is used as a debit initially, it's eventually closed out into retained earnings at year end. Now, to continue this example, the next year, 2015, the corporation declares a $50,000 cash dividend. Let's see how the allocation of dividends to each class of stock occurs. First of all, we know there was in 2014, $6,000 was declared, all applicable to the preferred shareholders. Now, in 2015, $50,000 is declared in total. Let's allocate that. The first $2,000 is allocated to the preferred shareholders since they did not receive their allotment in the previous year. Secondly, the preferred shareholders get their current year dividend of $8,000 allocated to them. out of that $50,000 total declaration. And so lastly, the common shareholders get $40,000 of that. Let's record the journal entry related to that $50,000 cash dividend. Debit cash dividends or debit retained earnings directly, $50,000, the total value of the dividend. Credit dividends payable, $50,000. Again, two accounts could have been used here for dividends payable. We could have split that between dividends payable dash preferred shareholders, total of $10,000, and dividends payable dash common shareholders, $40,000. In this case here, we're just using one account. Again, this journal entry just indicates the journal entry at declaration time. Upon payment, dividends payable will be decreased with a debit and cash with a credit at the payment date. Let's move to stock dividends now. Now, stock dividends are a pro rata distribution of the corporation's own existing stock. If we had 40 shares of outstanding stock at the time of a stock dividend, after the declaration and payment of a stock dividend, there'll be more shares outstanding. A stock dividend results in a reduction in retained earnings and an increase in paid-in capital. Using paid-in capital as a generic term, stock account, additional paid-in capital account. It's important to note that no asset is transferred from the corporation to stockholders when a stock dividend is declared. It's just a reclassing journal entry for stock dividends within the equity section. Again, moving dollars from retained earnings into the stock and additional paid-in capital accounts. Journal entry only. Even though there's more shares issued to shareholders, the percentage of stock owned by each shareholder remains the same. There's no distinct advantage in a stock dividend to individual shareholders. Reclassification entry only. Retained earnings goes down. The paid-in capital section, common stock, additional paid-in capital, increases. Why would corporations declare and pay a stock dividend? First, it may satisfy stockholders' dividend expectations without spending cash. It could increase the marketability of the corporation's stock. How could it do that? If you put more stock out there, there'll be a downward pressure on the market price of the stock, and it may sell at a lower price to maybe more appealing to buyers of the stock at a lower cost. What the stock dividend does do, it does emphasize that a portion of the stockholders' equity, that is retained earnings, has been permanently reinvested in the business. Remember that journal entry. It reduces retained earnings and increases stock. Any reduction of retained earnings means that future cash dividends cannot be declared on that portion of the stock that has been distributed as a stock dividend. That's the downside of a stock dividend to shareholders. Now, there are two types of stock dividends: small stock dividends, large stock dividends. What defines them? If a stock dividend is declared that's between 20 and 25% of the corporation's issued stock, that's considered a small stock dividend. Stock dividends that are declared that are greater than 25%, that's a large stock dividend. We'll concentrate on small stock dividends that are more common. And in fact, it's common for a stock dividend to say a 1% stock dividend or a 5% stock dividend. What does that mean? That means whatever outstanding shares exist, that percent, 5%, 6%, will be additionally distributed to existing shareholders. And so the first task of a stock dividend is to determine the dollar value of it. Let's take an example. Mellon Corporation declares a 10% stock dividend on its 50,000 current outstanding shares, $10 par value. The current fair market value of the stock is $15 per share. Let's record the entry upon the declaration date of this stock dividend. First, how many shares are involved? Let's take 10% times 50,000 outstanding shares, 5,000 shares. Those are the additional ones that'll be distributed under this stock dividend. So 5,000 shares times what? What's its current market value? $15 a share, or a total of, so the total value of the stock dividend is $75,000. Let's debit stock dividends for $75,000. We could also debit retained earnings directly. Again, that's my preference. Why do I prefer a direct debit to retained earnings? It shows that retained earnings are reduced in any dividend declaration, be cash or stock dividends. Retained earnings is the account that's eventually reduced. What's our credit? Common stock dividends distributable. Par value, $10 per share times 5,000 shares, $50,000. But the total value of the dividend was based on the market value of $15. So the extra $5 goes to additional paid-in capital, $5 a share times 5,000 shares, or $25,000. Now, why is the company crediting an account called Common Stock Dividends Distributable? Because at declaration date, the shares are not yet issued. So between declaration date and payment date of this stock dividend, that Common Stock Dividends account distributable will be part of the paid-in capital section of the balance sheet, as shown below. It's added in there. And when the shares are issued, the amount will reclass up we'll eliminate the distributable account and put it into the total common stock account. Here's the journals upon issuance of the shares itself, or if you will, payment of the stock dividend. Remove the common stock dividend distributable value, debit to $50,000. That zeroes out the credit in the previous entry. Crediting common stock, $50,000. So we're increasing the common stock account and bringing down the dividend distributable account in this entry. We're removing the distributable credit balance with a debit and establishing the regular common stock account with a credit. This is par value only. The stock now is issued. The previous entry to crediting the APEC account stands as is. Let's look at that again. The paid-in capital in excess of par, $25,000, that remains. It's just the actual distribution of the stock that brings the reclassification to the common stock account for the par value. What are the effects of a stock dividend? In this example, we declared a $5,000 stock dividend on existing 50,000 shares. So we're talking about issuing an additional 5,000 shares to existing stockholders. After the dividend is paid, that is, the issued shares are given to the existing shareholders, common stock increases $50,000, 5,000 shares at $10 par value, and the additional paid-in capital account increases the other $25,000 for a total of $75,000. In effect here, we have a reclass from our retained earnings. It was $300,000, moved to $225,000, and the paid-in capital moves from $500,000 to $575,000. Simply a reclass of $75,000 between sections, between lines within the equity section of the balance sheet. No change to the par value per share. Review question. Which of the following statements about small stock dividends is true? C. The market value per share should be assigned to the dividend shares as the value of that stock dividend. That is, that's the value of the journal entry. Debiting or reducing retained earnings and crediting paid-in capital as shares are issued. Question. In the stockholders' equity section, common stock dividends distributable is reported as what? In addition to capital stock. So between declaration date of the stock dividend and its issuance, that distributable account is part of the capital stock section. It's a temporary addition to the stock section. After the stock dividend is declared, but before it's issued. And once it's issued, the dollars in the distributable account will be zeroed out and are reclassed to the normal common stock account. Let's move to stock splits. What are they? They are issuance of additional shares to stockholders according to their present percentage of ownership. It reduces the market value of shares. Why? Because now more shares are in the marketplace, and so it'll tend to bring down the market value of the shares. We will not record an entry for a stock split. No journal entry for a stock split. In effect, the stock split is simply saying if shareholders in total owned 400 shares and there was a 2-for-1 stock split, now there's 800 shares outstanding. Just increasing the number of shares outstanding by a vote of the board of directors. It will decrease the par value and increase the number of shares that are in the hands of shareholders. But no journal entry. Let's look at the effect of a stock split for shareholders. If there were 40 shares before the stock split and there were 160 shares after, that indicates a 4-to-1 stock split. No immediate economic advantage to shareholders in the stock split. Again, tends to drive down the market price of shares because there's more shares outstanding, but we haven't changed anything externally. Let's look at another example of a stock split. Let's say Midland Corporation did a 2-for-1 stock split when it had 50,000 shares of common stock outstanding. So the corporation is saying, if there are 50,000 shares outstanding, let's make that 100,000 shares. So the shares simply go from 50,000 shares to 100,000 shares. There's no change in the common stock value, but there is a change in the par value. In effect, $500,000 divided by now 100,000 shares makes it a $5 par value. That's a memo basis only, no journal entry. The corporation simply notes a change in par value of the stock because more shares have been issued, but there's no journal entry, reclassing dollar amounts, change in par value only, memo basis. Here's a short recap to all activity that can affect the retained earnings account. Net income would increase it at year end. Net losses would decrease it. Corrections of prior period adjustments would either increase or decrease retained earnings directly. Some disposals of treasury stock, which we haven't talked about, could decrease retained earnings, but the focus of this talk was here on cash dividends and stock dividends. What are they and how are they recorded? Cash dividends reduce assets to the corporation. Cash is actually paid to stockholders with a corresponding reduction in the equity section above, a debit to retained earnings. Stock dividends, no transfer of assets, but a reclassifying journal entry within the equity section of the balance sheet, increasing the stock accounts, reducing retained earnings. Please note that in a stock dividend, as you mentioned, this is effectively saying that some portion of previously earned income profits is now permanently invested. Why? Because we're making a journal entry reducing retained earnings and increasing the stock account. That reduction in retained earnings means that there can be no cash dividends paid to that extent in the future. Brief comment here. On the initial incorporation of a company, the authorized shares are specified in the charter. Total authorized shares, potential for issuance. Now the corporation starts obtaining money and issuing some of its shares, it'll sell a portion of those. And if a corporation buys back off the market later some of those issued shares, the issued shares can technically remain the same, however, the outstanding shares in the owner's hands decreases. If any cash dividends are declared, it's based on outstanding shares. And so treasury shares temporarily owned by a corporation, buying some back off the market, they cannot pay themselves a dividend for treasury shares held by the corporation itself.